All right, so in this video, I want to talk about some more probabilities with the SPY, which is the general market. And I want to talk about this trade I made that was profitable today. So first of all, I'm going to go to Yahoo Finance. I'm going to look up SPY, and then I'm going to look at historical data. Oh, wow. Look at the SPY after hours, 225. Okay, that's good. All right, so I'm going to look up historical data. I'm going to choose max. All right, so from January 28, 1993 to March 22nd, 2020, I'm going to choose daily, click apply, and then I'm going to download data. All right, so now I'm going to open the Excel spreadsheet, and let me explain what I'm doing here. So I have all the daily prices of the SPY from 1993. What I'm going to compare is open and close. Here's what I want to compare. I want to compare what is the difference. What is the movement of the SPY from opening to close on average since 1993? I mean, so it's a lot of data. So here's what I'm going to do. I'm just going to add a formula over here. So I'm going to round. I'm going to do the close divided by the open minus 1, just to get the actual difference, the delta, the variance. And then I'm going to round to 2 decimals, close the parentheses. And then I'm going to extend the formula. So, and I guess I could put it in percentages so it looks easier. So basically it's saying that on that day, January 29th, there was no change between the open price and the closing price of the SPY. In this case over here, February 3rd, there was a difference of 1% between the open price and the close price. Okay. So now I'm going to choose everything. I'm going to open another spreadsheet. I'm going to paste as values, and I'm going to put it as percentages again so it's easier to read. And now I'm going to count how many times the percentages come up. So count if, the range will be the whole column, the criteria is the single cell, close the parentheses, and then I'm going to extend the formula, and you could see how many times each percentages comes up. But because there's more than one percentages, the values are duplicated. So I'm gonna first copy and paste the values, just remove the formulas so there's no conflict or confusion, and then I'm gonna remove the duplicates over here, remove duplicates. All right, so now I don't have any more duplicates. Just gonna name the columns whatever here, A, B, and then I want to sort this first column here from largest to smallest. So basically this number here represents the movement of the SPY between open and close. So basically 9% here means that the SPY closed 9% higher from the open. How many times since 1993? So remember my data goes back to 1993. How many times did that happen? It actually only happened 1 time, because this here is the number of occurrences. So I'm actually covering 6,835 days. 6,835 open days, business days. SPY moved 8% close, or the SPY closed 8% higher from the open twice since 1993. As you can see, the bulk of the movements is over here. The bulk of the occurrences is right over here. So the difference between the SPY open and SPY close was 0%, 3,789 times out of a total of 6,835 days. Now let's see what it looks like in terms of percentage. So I'm just going to take each cell and just divide it by the total. So divided by the sum of the column here. Why did I get a mistake? Type something too quickly. So equals this divided by the sum of this here. And just extend the formula. Put it in percentages so it looks better. And then here I'm just going to do a quick total of the percentages so it looks easier. So this plus this here. So basically this column here is basically the sum of, if I'm over here, I want to see how much all this gives me. So I'm basically just adding up all the cells here. So this cell here would be adding up all this over here. Okay, so I'm just going to extend the formula. And it makes sense that the last cell includes everything, so it should give me 100%. So it works, and I'm just going to add some color to it so it's easier on the eyes. All right, so look at this percentage. So, all right, so if I look at the stat over here, so how many times did it not move from open to close? 78% of the time. Actually, it's 55% of the time, but 78% of the time, the SPY closed at the same price or higher from its open price. All right. 78% of the time, the SPY closed higher or at the same price than the open price. So for example, go back to Yahoo Finance today. If we look at the SPY today, looking up SPY, go to summary. Man, it's crazy. The market's coming back up. It's really ridiculous. All right. So today, SPY opened at 228. All right. So that means that there was, according to 6,800 days of stats or data, SPY has a 78%. What was the percentage again? 78% chance of closing the day at 228 or higher. Okay. Today, it actually closed at 222, 223. Today, it closed 3% lower than the open of 228. Okay. So let's look at the percentages. What if it closes lower? So you could see over here, 3% lower than the open or higher. We've got a 99% chance. So it's got a 99% chance that the SPY, there's a 99% chance that the SPY will close either 3% lower or higher at the end of the day compared to the open. So basically the trade that I made today, as soon as the SPY opened, it opened at 228. I went and sold a put spread at 215 today, expiring today. So what's great about the SPY is that it has expirations Monday, Wednesday, and Friday. So I sold a put spread at a 215 strike. So what percentage of the open price does that represent? That represents a drop of, so 94, a drop of 6%. So basically, or 5.7% to be exact. So basically, 5.7% is around here, right? So basically, according to 6,000, how many occurrences do we have here? According to 6,835 days of data. All right, SPY has less than 1% chance of closing lower from the open by 5%. So basically that 215 strike, it's a put spread, right? So I've got a very good chance that the SPY closes above 215. I collected $70 for that trade. I risked $430 because it was a 5-point wide spread. But of course, I wasn't going to let the spread go to max loss of $430. My plan was the spread that I sold for $70, if that value increased to $210, so 3 times the credit collected, I would close the trade. So it would be like a mental stop loss that I would put in place. But for that to happen, I think SPY would have needed to drop a lot, even closer to 215. It actually dropped all the way down to 218 today. Here, let's look at the chart here. So you see the low of the day. You could see the low of the day here. Day's range was 218. So 3 points away from my 215 strike. And my stop loss wasn't reached, which was $2.10. So my plan was I'll get out. I'll take the loss if I have to get out at a $2. If I have to pay $2.10 to close the trade, then I'll get out, because I don't want to have to pay $5 and lose $430. And luckily, it went all the way to $1.20, $1.30, but then it came back down. And then, of course, because it ended up closing above 215, then the options expired worthless, so I didn't have to pay anything to buy it back. So basically that $70 I collected is all mine minus commission, so it's about $64 is all mine. But what I like about this trade is basically, if we look at the return on capital, it's basically $70 divided by, basically I was risking 210 minus the $70 I already collected, so I was risking basically 140. So it's actually a 50% return on capital. If you want to compare it to the max loss possible, if I didn't have a stop loss, then I'm actually risking my return on capital would be 70 divided by 430. So that's a 16% return. But because I didn't plan, I wasn't going to let it go all the way to a max loss. I was going to stop out at 3 times the initial credit received. So yeah, so basically, because I know that there's a very small chance that the SPY closes below 6% of its open price, I felt comfortable doing this trade. So remember, this covers from 1993 to 2020. Now let's look at specific periods where the market is crashing. So a specific period where the market is crashing is October 2007, because that's when it was at a high, and that's when it started dropping. If we look at October 2007, where is October 2007? All right, so let's take the data from October 2007 until March 2009. That's when it started going back up again, okay? So that was the last crash. Pretty fast dropping crash. So let's highlight all the way to end of March 2009. Okay, so now I'm taking specific years. I'm taking about 2 years just to see what it looks like during a crash, what the probabilities look like during a crash. Okay, so I'm doing the same thing. I'm going to put percentages here. I'm going to count the number of occurrences these percentages came up. So count if, the column, and the cell, and then I'm going to extend the formula, and then I'm going to copy paste the values as values, because I'm going to remove the duplicates so that it doesn't cause confusion. All right, so this is the number. So in between 2007 and 2009, the SPY closed at the same price as its open price 120 times. Okay, so I'm just going to give the column a name here, A, B, whatever. I'm going to sort by largest to smallest in terms of the percentages, okay? So there you go. You could see that one time during that period between 2007 and 2009 here, let me just rename the tab here, 2007 to 2009, okay? So between 2007 and 2009, SPY closed 8% higher than the open price one time. And as you can see here, the worst ever drop in one day was 9%. So the SPY opened at a particular price. It opened at a particular price one given day, and it actually dropped 9% at the end of the day. So intraday, it dropped 9%. So obviously it doesn't happen that often. It happened once between 2007 and 2009, but you still have some big days, 8%, 7%, 6%, 5%. It happened quite a like 9 times in the period of 2007, 2009. Let's look at it in a percentage view. So I'm going to take that divided by the sum of the column. So I'm just showing you all the steps so you could see for yourself how to calculate it yourself if you want to do it with other stocks, and just so that you can really validate the data, the information. Okay. So, and then I'm going to put the total of percentages. I'm going to do an addition. So this equals this. And like I did with the other tab. So this plus this. And then I'm going to extend the formula. I'm just going to give it a nice color here so it's easier to see. All right. So during the 2008, 2009 crash, obviously the probability is different. So here, the SPY closed at the same price or higher of the open price 62% of the time during 2007 and 2009. But if we look at the full period of the SPY between 1993 and 2020, it's a higher percentage, 78% of the time. But still, 62% is pretty high. 62% of the time, even during the 2007-2009 crash, the SPY closed at the same price of the open price or higher, 62%. That's pretty good. Now let's go a little bit lower. So I was at the 5% range today, right? My short put was at 215, and the open price today was 228. So that's a 94%, so minus 1. So that's a 5.7% drop. So let's say I was at the 6% range, and that happens 99. I would have won 99% of the time between 2007 and 2009. So it's still a very good percentage, of course, very good probability of winning. So basically it says that regardless of the open price of the SPY, it will not close the day lower than 6%. And that will not happen. There's a 99% chance that that will not happen, that it will close below its open price by 6%. So in terms of occurrences, it happened once. At night, it took a 9% drop intraday. It took an 8% drop once at 7, 3 times at 6, 3 times at 5%, 3 times it dropped 4%, 17 times it dropped 3% intraday. So you could see where the bulk of the movement is. It's right over here between 3% and 3%. 120 times it did nothing out of between 2007 and 2009. So the reason behind that is, in my opinion, and what I'm seeing is, during a market crash, the bulk of the movement happens outside of the market hours. So the stock usually opens, it already drops whatever it had to drop, whether it's 10% or 15% or 5%, it already opens with that value already dropped. What happens intraday, it's rare that it falls even more intraday. So the bulk of the movement happens outside the trading hours. So you could buy, so that means you could buy the stock, SPY could have been at 230 yesterday, but then it opens the next day at 220. It already made its move after hours. But then once it opens at 220, it's not gonna drop another 10 points most of the time. Of course, everything's possible. I mean, we've seen it drop 9%, but most of the time, the bulk of the movement happens after hours, which is perfect. If in this case, because I'm just comparing from open to close, and we could see that since 1993, the 9% also only happens once. So most likely this 9% comes from the 2007-2009 period. And so yeah, that explains why I made this trade today, and I'm pretty happy because it worked. Doesn't mean that it's going to work all the time, of course. I also could have done it on the other side. I could have done it on the call side, because at the same time I could see that only 1% of the time will it be trading above 6%. It'll be trading 6% higher than the open price. So you can see here that it's a 1% chance that if the SPY opens at 228, it's got a 1% chance of actually closing the day at 228 times 1.06. It's got a 1% chance of closing the day 241 or higher if SPY open at 228 today. So I could have sold a call spread. So I could have done a call spread at 240 and 245. But the issue with call spreads, in my opinion, is you don't get as much premiums as you get with puts, because puts, obviously, it's more of people will buy puts because of fear and they're afraid that the stock will drop. So they're more in demand, and that's why they're more expensive. So if you're selling puts, you're going to be collecting more from selling puts than from selling calls. So yeah, I just wanted to share this trade with you. Let me know what you think. What do you think of the probabilities? What do you think of the analysis? If it makes sense, is it safe? In my opinion, I think it's good because I'm covering since 1993, and I'm even covering the worst period ever, which is 2000 to 2009. Doesn't mean that we cannot create a new worst period ever. I think we're in the process of creating it, but this data here actually includes part of it. And you know what? Let's do the last 20 days actually. I think the market dropped starting February 20th. Here, let's take February 21st, 2020 to March 20th. All right. Let's include this here. Let's have our own little table here. It's such a small amount, but let's just see what it gives us. If it gives us something similar to 2007, 2009 data. Okay, so I'm going to change it to percentage. And then I'm going to count. So equals count if range sell. And then I'm going to extend the formula, and then I'm going to copy paste the values because I'm going to remove the duplicates if there are any. It's such a small amount of data. Remove duplicates. Yes, okay, I removed some duplicates. I'm going to give the columns a name. And then I'm going to just sort by largest to smallest. So right away you could see that it dropped in the same day from open to close. It dropped 6%. That was the biggest drop for the SPY in that period. And then you've got 3% that happened 4 times, 2% that it happened once, 1% it dropped 1% 4 times. So let's look at it in a percentage view. So this equals, actually, let's just copy the formula. So sheet 3, there we go. There we go, beautiful. All right, so 0%. So in the crash that we're in the process of, the SPY closed at the same price as the open. So how many times what is the percentage or the probability where the SPY closed at the same price as the open price or higher? So in the last 5 or 6 weeks, that happened 52% of the time. How many times did the SPY close 2% or 2% lower than the opening price or higher? So at this range here, it happened 76% of the time. So today my short put at 215 was 5.7% away. So it's actually at 6%. So it was actually, I actually had a 100% chance of winning based on these 5 weeks of data that shows that the biggest drop after opening. So not after hours, after opening. So the open price. All right. So if you have any questions, leave them in the comment section below. Let me know what you think of this idea. I think I'm going to try it again tomorrow. There is no expiration tomorrow. The next expiration is Wednesday, but I could try to close the trade tomorrow at end of day. What I like about this is that I don't have the overnight risk, because right now, as you can see, SPY is doing crazy things after hours, or the market is doing crazy things after hours. We see 10 points or 20 points drop. You open the market opens and it's already down 10%. So you really, your existing positions cannot be saved. So I think this might be better because you're out of the trade before the market closes, so you don't have to deal with surprises that happen after hours. So I might try it tomorrow. Thing is, because expiration won't be tomorrow, it might not be as profitable as the same day expiration, because there's still time value left. There'll be a day left in the options premiums. So maybe I'll do it, maybe not. Maybe I'll just do it on Wednesday, and hopefully it's a consistent play, as long as my short put is far enough from the open price. Now, of course, I'm able to go this far because VIX is so high, volatility is so high right now, so I'm able to go this far. But when VIX comes back down to 15 or 10, I'm not going to be able to go that far, of course. So that means if SPY is trading at 228, I'm going to have to go to 226, for example, as a short put. So I'm going to be very close. But let's see what that would give me. So this includes all the years since 1993. So if I had to sell at a 226 short put when the SPY opened at 228, see, that gives me a drop of only 1%. So that would put me around here, which still gives me a 94% chance of winning. So yeah, I think I'm gonna try this as long as I can until the market rebounds, because my 30-day spreads they're all becoming losers right now. If I log into my account quickly here, let me just log in. Don't look at my password. All right, Questrade, waiting for login. All right, so if we look at my margin account and I look at my positions, oh, look at that, negative 89,000, beautiful. All right, so if I look at my positions, you could see that this SPY put spread at 295, it's gone. It's a loss. This SPY put spread at 290 is a loss, even if it's 30 days, even if I still have time on the trade. This SPY put spread 280 is a loss. This one is the only one that still has life, but I mean, I'm not far off either. It's a 210 short put expiring April 15. I've got 23 days to go, but I mean, anything can happen. SPY can drop below that. So this is the one that I placed today. It should expire worthless. I guess tomorrow it'll disappear from the account, expiring March 23rd. So I opened it for $70 and it'll expire worthless. This one here, 260. I mean, it's got a chance, right? If the market does well, it has a chance. It's got 16 days to go, but I don't think so. This one at 300 is dead. This one at 240 has a chance as well if the market behaves itself. Yeah, I think it has a good chance. So yeah, as you can see, most of my put spreads have become losers because I end up holding it. 30 days is not a lot, but in this market, anything can happen in 30 days, sadly. So that's why I think dailies might be better right now. Because VIX is so high, you can actually get a lot of space, a lot of space between the open price. You can be far enough from the open price and collect as much as I'm collecting on the 30-day trade. So on the 30-day trades, I usually collect anywhere between $55 and $100. So I just collected $70 from a one-day trade. So it's as much as a 30-day trade, but in one day. So I don't like talking about this trade. I just did it once and it was good. I'm afraid that it never works again, but I felt like sharing it because I just like talking about trading strategies. All right, I hope you liked this video. If you did like it, please click on that like button below the video. Share the video with other people that might be interested in this topic. And if you are going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.